Hey guys, welcome to today's session. I'm just going to double check that the session is running smoothly. I've been having internet issues for the past week, which is super frustrating. And what it's doing is it's causing issues when I'm trying to stream. You'll probably see as we go through this presentation, there's a picture of me that doesn't load. And so I'm just going to check that it's running okay and that you guys can hear me and see me or see my screen if you're listening on the Discord. And then we'll jump straight in and get started. There we go. Perfect. Sounds all good. If at any point throughout the session my audio starts playing up or there seems to be a connection issue, please just post a comment in the chat box, whichever platform that you're watching this on, and just give me a heads up, and so I can kind of try and recalibrate things. Also, if you do have any questions as we go through this session, I'm aware we go into quite complex topics. So if there's any questions that arise during the session, please, again, feel free to post them in the comments and I'll go through them as we go through the session so that you at least walk away from this session with any questions that you have answered during the session. If at any point you miss something that you want to rewatch, all of these sessions and every session that we do that is live also gets recorded and uploaded to YouTube or X, so you can go back whenever you want and watch the sessions again. Here we go. First case of my poor connection. My name is Kieran and I'm head of the UK growth and business development here at Darwinex Zero. If you don't know who Darwinex are, I'll give you a brief 30-second intro to who we are as a business and what our main goal is. So Darwinex is an FCA regulated asset manager and broker, and we've recently launched our hedge fund as well. We are regulated in the UK by the FCA, in Spain by the CNMB, and also in the Seychelles by the FSA. We currently have over 100 million US dollars invested on our platform by professional and retail investors, and we have over 10,000 active strategies too. Wazmataz, I can see your message. Please review FMFR Darwin when you can. I do the Darwin reviews on a Wednesday, so I'm happy to do that next week for you. If you can't wait till next Wednesday, then send me a direct message and I will potentially record a video for you if I get time instead of doing it publicly. But if not, the Wednesday session next week will be the perfect time to do that for you. Our main goal as a company is to help our traders scale in every which way. So we already provide virtual capital for traders to trade with and scale with, and we bring in third-party investors, and more recently our hedge fund, where we have our own capital and are also raising capital again from third-party investors, which directly goes through to our traders. Our goal and business model is to bring as much capital to you guys as is humanly possible. So our ethics and ethos and morals completely align with our traders. We want to find the best trading talent because we're genuinely raising capital to bring it through to you guys. So the better you trade, the higher chance that you have of securing investment with Darwinex. Now, before we get into what is the point of a Darwin is an indexed version of your trading strategy. Roy Boy says I'm breaking up. Thanks for letting me know, dude. I appreciate you you giving me the heads up. I wonder if it could be because I'm streaming it on Discord as well as the other platforms that run through StreamYard. So maybe Discord's kind of lagging a little bit on the quality. My connection is secure, but like I say, I think somebody drilled through an internet line a couple of weeks ago, and they've been fixing it, and it's just not been right since. Is this any better now, Roy? I hope it is, but perfect, awesome. Thank you for giving me the heads up, and feel free to give me a shout again if I start breaking up again. Now, as I was saying, your Darwin is an indexed version of your trading strategy. So as the S&P, for example, is an indexed version or an index collective of the top 500 companies in the US, your Darwin is an indexed version of your trading strategy. So think of your trading strategy as a company, okay? Or your trades as a company. and your Darwin is the index that holds all of those trades or all of those companies. It's the easiest way to understand what a Darwin is. And the reason I outline that is because a lot of traders come to us, they will trade their MetaTrader account, and then they will be confused why their Darwin is slightly different, which we'll get onto in a moment as we move through the presentation. But I just wanted to distinguish at the beginning exactly what a Darwin is, so that for the rest of this session, if you are unsure, at least you know within the context of what I'm talking about exactly what I mean. Now, what is the point of having a Darwin or an indexed version of your strategy? Number one, it's risk adjusted. So that means so many different things and brings so many benefits to the trader. But first and foremost is it means that you can onboard investors without having to worry about blowing up their capital or blowing up your account, because even if you were to do that at MetaTrader level, your Darwin would not blow up, because our risk engine is intervening pretty much 24/7 to make sure that the investor's capital remains safe and that their exposure stays underneath a certain threshold. Now, what that means is you can, sleep well at night knowing that your investors, whilst exposed to the market and whilst exposed to your trades, aren't going to come hunting for you because you've blown up their capital. Number two, you come under the Darwinex regulatory compliance. Now, depending on where you are in the world, of course, will affect the complexity of this issue. So for myself, for example, I'm in the UK. It is extremely difficult to be set up as a regulated asset manager, which is absolutely required if you're handling or managing investor funds. It can cost a lot of money. It can take a lot of time. And also the regulators can be a headache because you have to adhere to all of their rules. Now, as a singular person trying to raise capital and manage capital, it's a headache that you don't need. You might not have enough capital to actually do it. For example, with the FCA, you have to lock up a certain amount of capital, and we're usually talking in the millions. You lock up a certain amount of capital to prove that you're liquid enough to be conducting the business that you are. And for the majority of people, that's just kind of out of scope for what can be done. When you're trading with a Darwin, it's obviously held at Darwinex level under our asset management license, which means that we can legally take investor capital because we're also providing the risk management to the traders through our risk engine. And therefore you can operate using or trading investor capital without having to worry about running into issues legally, setting up a fund, raising capital, or dealing with the regulators. And last but not least, you get a proven track record. Now, I have been asked in the past about the track record, and the top and bottom of it is you get a verified track record that is risk adjusted. However, you can also take your broker statements if you was to apply for a job at a prop desk or a hedge fund, for example. You can take your broker statements and they know coming from Darwinex, it's coming from a regulated broker, and therefore there's going to be no fugazi with the trades. Nothing will have been amended, nothing will have been changed, and therefore you have your risk-adjusted track record, which is your Darwin, which is a public-facing record, and you also have your private track record, which would be your broker statements or your MetaTrader account, which you could show to people using a MyFX book or, like I say, exported broker trades. So you have the best of both worlds. Whereas if you went to a hedge fund asking for a job, and you take in a broker statement from an unregulated broker with a 1-star review on Trustpilot, people are going to have questions. So it's just important to bear that in mind. Now, going back to my point that the risk engine is adjusting your exposure at Darwin level, what's really important to remember here is that your MetaTrader statistics will be different from your Darwin statistics. In sub 0.001% of cases, they're going to be exactly the same. But that would mean that you have to operate at the same value at risk level consistently throughout your whole career, which is just unlikely to happen. And I'll get onto why in a moment. Now, our risk engine is a proprietary technology built by Darwinex, and it manages the risk on behalf of all of our traders and therefore our investors. And it does this in two ways. Manages the position size when you open the trade by calculating your value at risk that you operate at MetaTrader level. And then it also intervenes in trades if your deleverage, which is a proprietary metric that we use to manage and measure exposure, if your deleverage exceeds a threshold of what is considered normal for you, the risk engine can get involved and shave small portions of your trade off. Now, whenever you're in a trade on MetaTrader, your Darwin will always be in a trade. And I will show you in a moment how you can see all of this adjustment and how to find the trades that your Darwin is in. Now, with that in mind, our risk engine adjusts all of the traders at Darwinex's trade size to maintain a value at risk, or a VAR or VAR, of around 6.5% per month across the board. VAR estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, that's a lot of words. So what do we mean by that? I actually have an example to share with you so it makes it a little bit more digestible. For example, if a trader has a VAR of $1,000, or alternatively in this case 6.5%, that means with a 95% confidence level over 1 month, it means that there's a 95% chance that the trader will not lose more than $1,000, or 6.5%, in any single month. Now, of course, we are dealing with the unknown. We're in the market. Anything can happen. A black swan event can happen. Volatility can increase at any time. And therefore, with that in mind, nothing is 100%. However, what we're trying to do is mitigate the downside when things get really, really bad. And we can calculate that using VAR to within a confidence level of 95%. So we're essentially saying to an investor, within 95% of the time, the maximum downside you will see in a single month is 6.5%. And why 6.5%? I'm jumping ahead of myself here. Why 6.5% for value at risk? And the simple fact is 6.5% VAR is the S&P 500's risk level. We know that investors are familiar with this risk level, and they're proven to tolerate it over an extended period of time, holding through stagnations, drawdowns, volatility, and they will keep their investment there. So what we do, or what we are doing in theory, is adjusting your strategy to a risk level that ensures it meets an investor's expectations and risk tolerance. Now, if I jump back a couple of slides to what I skipped over, by us doing this and implementing the risk engine on every single trader on our platform, what it does is it creates a level playing field, ensuring that every trader is judged based on their skill and not just by the amount of risk that one is willing to take. What I mean by that is, if we had two traders, and we actually use this in an example shortly in the presentation, if we have two traders and they take the exact same trades, one trader takes it with a 5 lot, the other one takes it with a 3 lot, for example, and they open the trade at the same time, close the trade at the same time. Of course, trader A, who trades with a 5 lot, is going to make a higher P&L than trader B, who trades, with a smaller size. Does it mean that trader A is a better trader just because they had more size down? Of course, there's arguments for yes, because the trader may be more confident, but at face value, the only difference was position sizing. It doesn't differentiate from skill. And therefore, what we want to do, especially in the retail industry, is not allow traders who are more conservative with their risk and take that longer approach, or that kind of higher time frame approach to their progress. We don't want those guys to get stunted by somebody who's happy to come on and open 100 lots on dollar yen and kind of run it for 100 ticks, but then can't make profit for the next 6 months. So we're creating a level playing field. That means every single trader is using the same exposure at any given time, meaning if trader A has a better return than trader B, they've done it using the same level of risk or the same level of exposure. Now you can see an image of the Darwinex Zero dashboard here, and it's important to know that any statistics that are shown on this site are risk adjusted. So the return, the drawdown, the return in the last 6 months are all your risk adjusted metrics. If you wanted to see your signal account statistics, so metrics from your MetaTrader, you can click the option that says signal account. And you'll notice on here, it's actually grayed out. And the reason it's grayed out is because we protect your intellectual property from anybody outside of you. Okay, so even I can't see anybody's IP or signal account statistics unless you specifically set them to be live. So you can set them. I think you have to do it on Darwinex.com. I don't think there's an option on Zero, but I could be wrong, and I'm happy to be corrected there. But you can set these to be live. It's completely down to the trader, but by default, we protect this information because we don't want... It's kind of irrelevant because the investment asset that's getting offered to an investor is the risk-adjusted Darwin. So it doesn't matter if an investor, it doesn't matter for an investor to see your signal account, because often it can be counterproductive to know that information. It doesn't make sense. If your strategy has a max drawdown of 4% at Darwin level, but your signal account has a max drawdown of 40%, well, of course, you kind of probably wouldn't want an investor to know that, because it might give the investor shaky boots, when in reality, they'll never see a 40% drawdown anyway, because your Darwin is a risk-adjusted version of your system. Now you can see on the screen right now, we have a VAR chart. And this is an organic chart that basically lives and breathes as you keep trading, right? Now, what I mean by that is, as your trading behavior adapts and changes over time, your VAR will also increase or decrease alongside that. Now, what we've done for this example is we've put a big fat white line of 6.5% just so that you can see exactly the point where you would be operating at 6.5% value at risk, which would mean no risk adjustment would be necessary. Of course, that only happens for, a tiny period of time here. And for the rest of the time, the trader is either above or below that level. Now you can see at the beginning, the trader was roughly 2x 6.5%, roughly about 13%, which would mean that whenever there's arrows pointing down on this image, the trader's size at Darwin level was being reduced. So at 13% value at risk, it's highly likely that the trader's size is being reduced by half, meaning if the trader takes a 10 lot position on signal account or on their MetaTrader, then their Darwin is probably trading a 5 lot. So it's pretty much half of what they're doing. As this comes down, your VAR works in tandem with another metric called your risk multiplier, which basically measures the percentage or the times increase or decrease from your original position sizing to your Darwin position sizing. So at 6.5% value at risk, your risk multiplier would be 1x. Okay. At 13%, your risk multiplier would be 0.5x. At 3.25% value at risk, your risk multiplier would be 2x, and so on and so forth. And they work inversely. As your VAR is coming down, odds are your risk multiplier is increasing. As your VAR goes up, your risk multiplier will be decreasing. So as this trader's VAR is coming down slowly over time, their risk multiplier will also be increasing over time. Now, when their VAR goes underneath 6.5%, you can see we've flipped the arrows, and that would therefore mean that the risk engine is actually increasing the size of the position taken at Darwin level. And all the while that the VAR is dropping, the risk multiplier is increasing, and the risk engine will be ramping up the size at Darwin level. Now, this remains stable on your equity curve at Darwin level, because generally when you're changing your position sizing, your P&L is going to flatten. For example, if you're dropping your position sizing, your VAR is going to drop, but the return that you make is also going to drop. So if we're scaling that up even more, your Darwin is still going to be coming out to the same end result anyway. And vice versa. If you're increasing your size at MetaTrader level, you'll probably make a bigger return. But because your VAR has increased, we will have scaled it down from a position sizing perspective. So again, your Darwin's P&L won't see the benefit, because we try and keep it stable as we can. Stability and consistency are kind of more important than anything when it comes to your VAR. And I often say this to people, there isn't necessarily a good or bad value at risk. It's the main thing that I would say that we look for is consistency, because the more consistent it is, the easier it is for our risk engine to adapt and to control the exposure over an extended period of time. Now, as I mentioned earlier, you do have an option, I guess option is the right word. You have an option to view the trades that are open on your Darwin. So in the bottom left-hand side of your screen, when logged into your account, and again, this is IP, so only you can see your own Darwin live trades, you have a small box that shows you your risk multiplier, which in this case is 2.32x, and your current closure rate. You can see in this example, that's 0%. But if the risk engine was to close any amount of exposure, so as I mentioned earlier, if the risk engine caps your exposure on a certain trade or shaves off some position sizing, it would show here as current closure rate X percentage. Underneath that, you can see that this trade is in a Kiwi yen short. They have 1.2 lots on at MetaTrader, but their Darwin has 2.79 lots on because of the 2.32x risk multiplier. Again, going back to trader A and trader B, we have trader A who trades with too high of a lot size. The risk engine is likely going to scale them down to the baseline of 6.5%. We have trader B who trades with too small of a lot size. Now, the odds are the risk engine is going to scale their size up at Darwin level. And both traders will meet in the middle at the sweet spot of 6.5% value at risk, which is our standard risk level for Darwins. Having said this, if an investor has a higher risk appetite, they can invest with leverage, so they can increase the VAR themselves, but that is completely down to the investor. We don't recommend that. We don't not recommend that, but we offer your Darwin out at 6.5% as a standard. I can come in as an investor and decide if I want to increase that 1, 2, or 3 times. Your VAR depends mainly on 4 factors. However, I do split these into 2 categories, and I'll explain why now. 1, 2, and 3 are in the first category, which is strategy-specific VAR metrics. So you have asset volatility. Every asset has a different level of volatility. For example, Bitcoin is highly volatile when compared to euro, dollar, or the Bund. Number 2, you have number of trades, which is your trade frequency. The more trades you take, the more exposure you're taking to the market, and generally just the more exposure that you have in general. And the same with trade duration. The longer you hold trades, the higher your value at risk would be, because you're holding exposure into the market for longer, meaning you're more exposed to black swan events, news events, volatility, and so on and so forth. These aren't necessarily good or bad metrics. For example, it's not to say you should trade less because you have a higher value at risk, or you should cut your trades sooner because your trade duration is too high. I generally put these into their own strategy specific category and say you work around these factors. Okay, so if you have an asset that works for you long term, you figure out your ideal frequency, and you can hold your trades for example, you don't want to be cutting your trades to reduce your value at risk when you know that you're leaving money on the table. So I tend to put those to the side, and I say the one thing that you can change or adapt is your position sizing, which is in its own category. And the reason I put it in its own category is because it is the only one out of these 4 options that you don't have to amend your strategy for. The other 3, you would have to reconfigure your strategy and think, okay, well, if I'm not trading, the NASDAQ, what asset am I going to trade? It might not work as well on the Dow or the S&P, for example. Trade frequency, you might have found the sweet spot for how many trades you need to execute to get the best entry. Trade duration, like I say, you might have worked on your maximum favorable excursion and know how many pips or points you should be targeting. We don't want to change that, okay? The only thing you should ever really change to adjust your value at risk is how much size am I putting down? I'm not changing anything from a strategy perspective to reduce my size from 0.8 lots to 0.5 lots. Literally all I'm doing is reducing my exposure to the market. Now, there's a few questions before we come to an end on this session, which I often get asked at the end of these sessions. Number 1 is, when will my Darwin be listed? And your Darwin goes through an initial calibration phase, which generally takes 15 days as a minimum. Can take slightly longer depending on your trading style and how consistent you are with risk. However, it will, whenever you finish the calibration phase, your Darwin will always be created over the weekend and then therefore go live on the following Monday. Number 2, which is a lead on, is, shall I stop trading whilst my Darwin is being created or listed? And absolutely not. Any trading activity at any point will always get counted towards your track record. As soon as your Darwin is listed, you will be then competing in Darwinia Silver and could be earning allocations. So never stop trading. Number 3, shall I increase or reduce my risk? The only time I would say to somebody you need to amend your risk is if you have a value at risk of over 30%. What we've seen over the past 15 years is that anybody who has a value at risk of over 30% has an exponentially higher chance of blowing their account up or going through a significant period of drawdown, like 50, 60, 70% drawdowns. So only if your VAR is above 30% would I say you should really take a look at how much risk you're taking. A, it's unhealthy for a trader to be taking too much risk, and B, you don't ever want to blow your account. Number 4, how do I increase my risk multiplier? I have already gone over this. It works inversely with your VAR. So to increase your risk multiplier, you would need to decrease your value at risk by reducing your position sizing. But essentially, your Darwin is always going to come out to the same end result anyway, as I mentioned earlier. And to follow on from my point about the 30% value at risk, is it bad to have a high or low multiplier? And I would say it's neither here nor there. The only time I would say something would be bad is if your VAR is above 30%. Just be careful of that. Like, understand that you are taking on, a large amount of risk to generate your return, and just make sure that you're not taking too much risk. So slowly bring it down over time. But it's not necessarily bad or good to have a high or low risk multiplier. The only thing I will say is if you are looking to change or lower your value at risk, do it gradually. Don't go from trading a 10 lot to a 1 lot overnight, because it will take a little while for your Darwin to catch up. Like I said, consistency is everything at Darwinex Zero. So reduce it slowly. Instead of going from 10 lots to 1 lot, go 10 lots, 9.9, 9.7, 9.5, and gradually reduce it over time. And that will allow the risk engine to gradually increase your risk multiplier over time, meaning that your equity curve stays stable and that your Darwin remains normal and doesn't see a huge drop off in P&L or a huge ramp up in risk. Finally, I just want to say a massive thank you for everybody joining today. I'll leave a minute to see if anybody has any questions. Sorry, I had a notification come through then. I'll give you all a minute to see if you have any questions. All I will ask is that if you trade with Darwinex Zero, the best place that you can come is to our Discord. We have over 10,500 traders in there now, and it's kind of the best place to be a part of the community. You'll be first to hear anything that happens at Darwinex, and it's kind of like a first line of support. So you can come into the Discord, you can drop a question or drop a message. And if I'm not there, which I usually am pretty much all day, every day, then we have tons of community members who are just fantastic people, and will always be willing to help you out with any questions or queries that you guys may have. Now I can see there's no questions coming through, so I'm going to take it that I've explained everything quite well, or at least I would hope. But if you do have any questions after this session, please feel free to rewatch the session, or join the Discord, message me on there, or email us at info@darwinexzero.com. We're always open for a chat. I'm always happy to jump on a call, whether you've got 1 question, 10 questions, 100 questions. Our job is to make you guys comfortable knowing what you're signing up for when trading with Darwinex Zero. So with that in mind, I hope you all have a fantastic rest of your week. Have a great weekend, and I will be back on Tuesday for our next session, which is a welcome session where we go 30,000 feet view into Darwinex as a company, who we are and what we do. It's a more simplistic version of today's session. So guys, if you want to watch that, I will see you on Tuesday. But without further ado, I hope you all have a fantastic weekend, and I will catch you next week. Peace out, guys.